Hello everyone, my name is Dixon Kamara. I have a master's in accounting and I have prepared some slides that I called Accounting Made Simple. This is mainly for beginners, for new students that are just taking accounting in their first class. If you go through my slides, you will find it interesting. And guess what? If you really understand it, your professor is gonna be in line with you and he's gonna love you. So let's get started. So this is always the equation in accounting. Asset equals to liabilities plus owner's equity. I have listed some assets which are cash, account receivables, supplies, equipment, delivery vans or delivery truck, buildings, and machinery. These are your assets. These are your assets. Cash is always cash. Cash in the hand or cash at bank. Accounts receivables. If you sell some goods to a customer or if you perform a service for a customer, but you haven't received payment or you will receive payment in the future dates. So this is the account that tracks all the money or the cash that you will be receiving in the future dates. You have supplies like if you are in an office, those little items like pens, pencils, or those simple stuff that facilitates your office work. These are your supplies. Equipment, let's say like computers in your office, those are equipment. Delivery trucks or vans, we all know what delivery trucks or vans are. Buildings, if you own a building in your workplace or if your company owns the building. Machinery, those machines that you use for production. Then you have account, you have liability, you have notes receivable. This is a formal one that is backed by a signature that payment is going to be due in a future date. Then you have account payable. This is an informal one, like an invoice. This the opposite of that is account receivable. That you let me say like you took some goods from somebody or from a supplier and you promised to pay at a future date. So this is the account that tracks that. And any payable, anything that has the word payable is a liability. So you have to really remember that. You can have salary payable, interest payable, notes. I already have notes payable and tax payables, all those. And you have owner's equity. You have the capital that you started the business with. That's the one that I'm talking about. And you have drawings. Drawings are like when you take money from your own business for your own personal use. Those are your drawings that you pay yourself from the business. Okay? This is mainly for a sole proprietorship. This formula can be changed as liabilities equals to assets minus owner's equity. It can also be changed to as owner's equity equals to asset minus liability. They can change it like in different ways, but it's up to you to understand it. But please pay attention to the terms. Those are your assets, your liabilities, and your owner's equity. So debit and credit rules to remember. All assets have a debit balance except and contra assets. All liabilities have a credit balance. All owner's equity has a credit balance. This is what I'm talking about is asset account like cash, account receivables, supplies, land, buildings, equipment, delivery vans. These assets they increase in the left and they decrease in the right. all assets increase in the right, in the left, and decrease in the right. So if you we anyway, I'm gonna explain that more in the next slide, in the next following slides. Liabilities is opposite to assets. Liabilities increase in the right and decrease in the left. Wherever you see the green color, that's the increase. Wherever you see the white color, that's the decrease. So pay attention to that. Owner's equity. Owner's equity or capital account is the same treatment as liabilities. They increase in the right and they decrease in the left. Drawings, like when you withdraw money from your business for personal use, like you paying yourself. So guess what? If capital accounts increase in the right, so when you withdraw money from the business, the money goes down. So that means it increases, drawings increases in the left. So you see the green over there in the drawings in the left side. Revenues. What are revenues? That you will understand as I go on. But revenues is any money that you own, that you get from performing a service, okay, or from selling goods. That's your revenues. Expenses are always against revenues, and that's where you get your net income or net loss. Okay, I will explain more as we go on, but I just want you to understand first how this goes. Okay. This is just a repetition of what I just said. Account balances. Assets have debit balances and increase in the left. Liabilities have debit balances and increase on the right. Owner's equity have credit balances and increases on the right. Revenue has credit balances and increases on the right. Expenses have debit balances and increase in the left. Just a repetition. Okay, this is just an interpretation of the equation using numbers, which is total assets equals to liabilities plus owner's equity. This is a balance sheet. This is a snapshot of a business showing what you have to pay, and what the business actually have. Okay, just a snapshot. That's the balance sheet. So this is an account form of a balance sheet. You have account form, which is like this, and you have a report form, which is just one column. You don't have these two columns. It's just one column, the report form. This is the account form of a balance sheet. So you have all the assets on the left side, and you have the liabilities and owner's equity on the right side. So as you can see, total assets is 2,150. Liabilities on the other side equals to total liabilities equals to 950, and owner's capital is 1,200. So those total to 2,150, which is total liabilities and owner's equity, and it is equals to total assets. I just classified these into two colors, telling you that these are permanent accounts and the other ones are temporal accounts. Permanent accounts are not closed until the end of the period, telling you that these are the updated accounts ready for the following year. So you close them in a post closing trial balance. And example of your permanent accounts are in green color. Pay attention to the green color. And these are cash, accounts receivable, supplies, equipment, delivery trucks, buildings. You can have as many assets there, like land. Um, as we go on, we will have more of these liabilities, accounts payables, notes receivable, salary payable, any payable, as I said. And you have owner security, which is capital. These are permanent accounts. They don't close until the post closing trial balance, ready for the next year. Then you have those in the red color, I think. I'm not sure if this is red, but I'll just say it's red color. Okay, you have revenues. First of all, you have net income, which is underneath. Net income underneath the capital. You have net income or loss. This is closed. You have drawings. Then you come to revenues. You have fees earned, commission fees, any revenues, any fees. Okay? Then you go to the broad one, expenses. You should have to know what is your expenses. Supply expenses, utility expenses, expense, insurance expense, rent expense, salary expense, and repair expense and miscellaneous expense. Miscellaneous expense could be like cleaning the carpets and like little transportations that sometimes you don't have nowhere to classify them. You would just like to make them on one call, on one expenses account. Utility expense, don't forget utility expense, like your phone bill, okay, your gas bill. Those are your utility expense. We all pay. Sometimes people pay insurance for their businesses, rent expense, which you understand, salary expense, which you understand. Supply expense is a broad topic, and you should not forget it. And we are going to see more because it's very critical to treat. So always pay attention to supply expense. So I have a list of transactions that you should understand, and these are one of the most transactions that I think repeats in most of these things that we do in our everyday life, and especially in today's businesses. So let's take a look at them. First of all, for you to understand any of these transactions, you have to read them. And just as everybody knows, understanding these transactions is part of your answers, is part of your solutions. So let's read them through. We have okay, let me see. I created this transaction, like the business person's name is Alfred. So Alfred invested on 10,000 cash into a business, bought supplies for cash, purchase equipment for cash, perform services for customers on credit, purchase additional supplies on account, customer paid for services performed on D, receive cash for performing services, paid delivery expenses. Alfred withdrew 700 cash for personal use, paid 600 on liability for supplies, purchased 800 of supplies on account, paid rent for the month, paid